All right, everybody. So the first thing we're going to do here before we look at the market open is just go over what the different aspects of day trade to win has, as well as some of the new things that I've added, which will be able to help you as traders. So the first thing we have here is the get started and the setup info. I've put here a list of things that traders email me all the time on how to download NinjaTrader, how to activate the licenses on NinjaTrader, especially for those of you who have my software. I also have here how to install, how to add indicators to the chart, and how to apply the data feeds to the chart. Those of you who request the 2-week data feed for NinjaTrader, how to open charts. So I've put together here under the setup info, get started, this list and these lists of things, and you can click on here any of these that will take you. How to load a chart. Under courses and software, besides all the courses that I offer and the mentorship, we have here under downloads as well the news indicator and downloading NinjaTrader. Those of you who are also looking at calendars, besides adding the news indicator to NinjaTrader, which I'll show you in a moment on my chart, I also have here an online news calendar. So I created this here so we could see news through a website as opposed to an indicator. Not everybody is using NinjaTrader, so instead of going and searching for economic calendars, I put here the US Economic Calendar and the investing.com calendar. And one of these, I forgot which one, has the ability to search and to look at history. So if you wanted to see what happened last month for a certain day when you're testing and you're looking at, especially one of the methods that I show and I teach, it's on YouTube, is trading the news. If you want to look at it and test it, and let's say what days in history were there these high priority news events, you can come and you can look at these here and you can search by dates and so on. All right, anyone have any questions for me? So this is a live webinar that I'm doing. It's not a pre-recorded webinar like a lot of people do. I invite questions, and if you do have any questions even after the webinar is over, you can email me at support@daytradetowin.com. I have here a videos section, so if you want to take a look at videos, and you can probably find these same videos on YouTube and on the blog, but I have here, I add these videos here from time to time, and there's probably 500 videos over the years that I've added as well, so you can go back in history. It's not just videos done yesterday or last week. There's lots of history there. And then there's the blog where I post information as well. And if you're into the social media aspect, if you want to know when there's specific times for holidays, usually I try to post these things here and the videos as well. Okay. So I wanted to show everyone the updates to DayTradeToWin.com. Get started, the setup info guide. Here under courses and software, you can look at the downloads, you can get the simulator, the trading the news as well. Here, videos, testimonial videos, and this is for the member login, right? To look at your member login videos for the training that we do for the courses and the mentorship. I put all the recorded videos for the mentorship here. All right. Okay, so to begin, let me just push this out of the way here. So if I look at the current chart here, this is a daily chart, and the daily chart on the E-mini S&P, as you can see, there's this huge rundown like this here. Now the bigger picture is that the market's volatile. That's what everybody should understand. The market is very volatile, and you should know that markets go up and down as cycles. They move up and they move down. And if I look back in history, and if I think that I'm panicking and that the sky is falling and everything's going to just continue to go lower, I'm going to just bring you here, not too far back here, where we could see a similar situation, a similar event back in October, where the market also went down significantly. And then it came back up. I'm bringing this to everyone's attention because right now there's a panic in the market. It's the selling frenzy. And even though the market may go lower, I don't think that the market will continue to go much lower. It has to come back to where it was, at least to test the highs. So I'm showing this to you because those of you who follow me know that I do every year the January effect video, which this year, by the way, the January effect video did not, or the January effect method, I should say, did not indicate the market will move higher and close higher. So that was done in January. And again, you can see the market went down, and probably a lot of people considered this a terrible move to the downside, but it eventually came back up. And I want you to take a look here at what it did specifically. All right, B, good morning. This being recorded, yes, for future use. Yes, you'll see it on the DayTradeToWin website under the blog or the video section. So even though the market went down here, as you can see it here, even though this occurred, I want you to focus on what happened about a month or two later where it went up and tested the highs. To me, this is more significant because I really can't tell you at the time that this is happening how far it's going to go or where it's going to stop or how fast it's going to move, at least not in the immediate and at the moment. But I can tell you that once it stops and starts to come back up, this is an opportunity that I want everyone to start taking a look at and start to say, what can I do with this information? In addition, you see that it not necessarily that it went straight up, but it stopped midway, which is right here, about midway. It stopped midway here in the center and got kind of stuck here, right? Came up, came down, came up, came down, came up, came down. So here's my proposal to everyone who's thinking about trading currently where we are right now. And if you look at this situation, I'm going to forward it right now to this situation here. I would expect that the market will move up to test these highs right here. I'm not suggesting it's going to happen tomorrow or within the next week or two, but you're going to see this area get stuck here for a bit and then do that. And when it comes to this point, all I can really say is that it wants to test the highs and wants to test where it's previously been. This is a common theme in price action. So what I'd like everyone to do is once the market, and just pay attention, once the market starts to break the midpoint, which it did just barely here, but once it starts to break the midpoint, give it a few points, maybe a day or two, and see it continue higher and higher before deciding to be a buyer. We could very well come down and test these lows that you see here at 28.50. This could absolutely happen. So I don't want anyone to not time this correctly. But if the market comes up to this midpoint and gets stuck, as you've seen here, this pattern, this situation, is exactly what you may see occurring here. So just be prepared. Don't sell or buy unless we have evidence. And the evidence to be a buyer is going to be when it begins to break this and stay above it by a day, a couple of points. You don't have to take a huge amount of profit. You could just have to take enough, 5, 6 points, especially with the current volatility. Once it starts to go in your favor, trail a stop, and you lock in, and you're playing with the house's money. All right, any questions? Tom, Richard, Prince. I have 2 Toms here in the room, 2 Jacks, Greg. All right, so that's the first thing. What are we going to look at as the market begins to climb up, or will it get stuck here? Will the market get stuck at this midpoint for a couple of weeks or a couple of days before it comes back up? All right, very good. Now, before we begin into looking at the signals, the trade scalp or the Atlas line, all that good stuff, just remember trading is risky. Please don't trade with funds you cannot afford to lose. Talk to your broker. I'm sure everyone has heard the disclaimer. Just understand that trading is risky. Let me move this out of the way. Anyone have any questions on this here? Similar to what I like to do with the January effect. Same type of idea. The method is the same. I like to wait until the market starts to come up before buying, but with evidence. This here is just a little wick, not enough evidence to say it's going to continue. Even if it starts to come up here like this, that's when you start to buy and to hold and to trail a stop. All right, let me put this out of the way here. So what you're seeing here right now currently is the Trade Scalper software on the E-mini S&P. Obviously, we have a lot of activity right now. The market's very volatile. So a range chart looks at each one of these candles here and says 2 ticks creates a new candle. 2 ticks movement up or down creates a new candle. So you can see how fast it is. It's very fast. And it's very fast in comparison to what we currently have in the volatility that exists. This obviously is very hard to trade unless you're paying attention, because as soon as the signal comes up and you're rushing to get into the move, you can see that it could become a problem where you're chasing it as opposed to getting in right. So here is my recommendation once again for those of you who have the trade scalper or who are scalp trading or who are thinking about getting the trade scalper as a method to trade. It's always best to get in at the price that the signal is intending. So if I switch gears here a little bit and go to the 1 minute chart, which this method was initially created for, a 1 minute chart right here. The signal to go short is 30.53 quarter. This is a 1 minute chart. It's the same Trade Scalper software. Now, as soon as this signal occurred, the market's on its way down. You're saying, well, I'm going to miss this trade because I'm not going to chase it. But you see how this came back to 30.53 quarter, even if you wanted a better price, 30.53.50, or within a couple of ticks of this because the market's volatile. This, to me, is the entry. This would be the entry to take. The same thing here on this long trade here. Once this signal appears and you're saying, okay, it was too fast, I missed it, whether it be the range chart or the 1 minute chart, look at what happened on the very next minute, the very next candle, where the market came back to 30, 60, 75, and even surpassed it by a couple of ticks, and then continued higher. This would be the entry to go long. Now, under normal conditions, the market's not this volatile. So for the traders out there, they're trying to make heads or tails of the current volatility. What you're seeing here is not normal. And for the new traders especially, this is not something that you're going to encounter. And for many years, we probably were complaining that the market was too slow to trade, where we didn't have enough action in the market. So this is now on the opposite spectrum. There's too much action here, which can obviously hurt you. If you're in a trade, the market moves very fast against you. So we have to be careful not to chase these signals or chase the market or chase this situation that we're seeing. Because, for example, if you have a signal here to go long and the signal occurred here, you're not going to enter long here, only to have to wither this whole reversal before it comes back up. So this is something that I want everyone to pay attention to as traders. Okay, you can't necessarily trade the same way when the market is fast in comparison when it's slow. Okay, it's not possible. Now, how do we know if the market's slow and how do we know if the market's fast? I like to use the ATR, the average true range. The ATR, the average true range, on a 2-range chart doesn't work. Every candle is 2 ticks up or down. So this is exactly 2 ticks. This will never change. This will never get to 1 tick. This will never get to 3 ticks. This will always be right here, half a point. So you can't use the ATR on a range chart. This is half a point. This is 0.75, and this is a quarter. The market will always get stuck within half a point, always. So you can't use the ATR on a range chart. That's the first thing. What about a minute chart, 5-minute chart, 30-minute chart? What about all that? Yes, yes, you can use the average true range on a 1-minute chart. The trade scalper was initially created to use on a 1-minute chart. As the market becomes more normal, the two range chart gets you in at better signals or better entries because it's normal. It's a normal market movement. But right now, if you're trading with the trade scalper or any type of scalping method, you have to use something that allows you to enter without rushing into it and getting bad fills. So the ATR, the average true range, let me explain to you a little bit for those of you who don't know or who are new, what this is all about. How do I use it? How should you use it as well? The first thing is when I add the ATR here to the chart, you right click on your chart, you choose indicators, and it's typically one of the first indicators here in the A section, the ATR, the average true range, right over here. Now, when you add the ATR, you double click on it, and it adds it down here, the ATR. And the setting is typically 14, it's defaulted. We're going to update that setting to a setting of 4. Now, once you update that setting to 4, so remember, defaulted on most charting platforms, TradeStation, eSignal, they're all 14. We're going to update that and change that to 4, and we're going to save it. And the way we save any new parameter or any change in properties that you want to keep is you come here to template, you come here to save, and you just click save as default. It's going to save what this is considered as default. It says default already exists, and you click yes. And that's it. And the next time that you bring up the ATR, it'll remember that you want to use a setting of 4. So that's the first thing, setting of 4 on the average true range. The second thing is that I want to look at what these numbers are telling me. They're telling me that the last 4 candles on average, so you say from high to low plus high to low plus high to low divided by 4 gives me a value. The value is 7.14. So what does that mean, 7.14? 7.14 is a value that indicates 7 points. 7 points up or down for the next candle as we go forward into the future. So think about what that means. It means that as the market into the future is moving up or down, I already have a clear understanding of the distance and the movement to expect. It's a leading indication of price moving up or down 7 points based on the last 4 candles. So if I look at this candle, I can almost guarantee to you that the high to low is roughly 7 points. Now the market is telling me that the next candle, the current candle, is going, the next minute, right, because this is a 1-minute chart, is going to move on average 6.5 or 6.75 of a point. The E-mini works in quarter point increments, so 6.73, you can round down, 6.5 or 6.5 quarter point increments. So this candle right now is going to move from high to low 6.5 points. Now, once this candle is finished plotting, it recalculates. So what it's doing this. The last 4 candles told me that I can expect 6 or 7 points moving forward. The next 4 candles, I can expect about the same. The next 4 candles, once this candle closes, it recalculates it. Now, this is really important because when you take a trade, you have to know the target, you have to know the stop, you have to know what and where price is going to move. So you can say, I'm not having a large stop unnecessarily, or I'm not having too small of a stop unnecessarily. So if I look at this currently where we're at, I can expect this next candle here to move 6.5 points. That is a target. That could be your stop. That could be distance that the market is going to move, so you can prepare yourself for a trailing stop. This could mean so many things for traders and to help you not just trade blindly, but trade where you know what to do and how to manage the trade. So this candle right here, if I put a ruler on this right here, that's the distance the market's going to move up or down. Now let me ask you, if you have a stop and the stop is 2 points, But yet I already know that the market can move 6.5 points. Just the random movement of it going up and down until it finds 6 points will take you out with such a small stop of just 2 points. So you have to look at the current conditions that exist at the moment to dictate your stop. At the same time, you could use the same value to dictate your targets. Because if I know the market's going to move 6.5 points, why not make that 6 points or 5.5 points or even 6.5 as your target for the market to move in your favor that distance? I can't expect 10 points or I can't expect 20 points, but I can expect 6.5. So the way that I like to approach the markets and how I teach people with the courses I offer is looking at the ATR to help me understand what to do next. What's the stop? What's the target? How do I manage the trade? That's the first thing. Now you see this candle is very, very big, much larger. The range is increasing, so 7.25 points is what I can expect from this candle here. Now the good thing is that this does not change or does not really differ unless there's a news event from candle to candle. It's all about the same. 7 points, 6.5, 7.25. It's all within that same area. So, and that's a good thing because when you're trying to understand the distance the market's going to move, we're not looking at this candle and the expectation being 7 points, and then the next candle being 3 points, and then the following candle after that just being 3 ticks. It's not the way it works. This here, if it moves, it'll probably move a tick or two up or down, but it's not going to be that much of a drastic difference. So you always have a good understanding of what the market is going to do. So the Atlas line long trade on a 1 minute chart is 30.45 to go long. Remember, I look at this as price action. This is the distance the market can move in my favor. I cannot have a stop that's smaller than 7 points because I know already that this can go up and this can go down 7 points. So if my stop is 2 points, I'm going to be taken out instantly as it moves up and down. So this is something that you should be aware of when you're taking a trade. Can't have stops that are so small that'll unnecessarily take you out. So that being said, 7 points on a trade like this, even if you just wanted 5 points, 5 points of a profit target from here to here, this is what I'm expecting. The market to move to this area, and that's it. All right. Now, stops. There's 3 or 4 different types of stops that I teach. They are based off of time. They are based off of proof. They are based off of pivots. Whichever stop occurs first is how I like to approach the trade. Not only a hard stop of price and not only a hard stop like a catastrophic stop. The stops that I use are intended to first keep you in the trade and secondly to get out if the market goes against you. So what are the different types of stops when it comes to time? Time-based stop is based off of 4 bars. If I cannot make the profit target within the next 4 candles, whether it be 4 candles on a 5 minute chart, 4 candles on a 1 minute chart, 4 candles on an hourly chart, so it's dynamic. You shouldn't be trading beyond that point because it's taking way too long for the market to go in your favor. Get out. Okay. So I have a limit on the time. So let's say that you have, let me just crunch this up here as an example. Let's say that I have a catastrophic stop that's here, and everybody says this catastrophic stop that you have is too big. You know your risk to reward ratio is too large, or it's upside down, let's say. And I have to say I'm not using this stop as my only stop or my catastrophic stop that I want to get stopped out on. I'm using this to keep me in the trade only if there's a catastrophe that I'm able to get out of the trade at that point where the market just went straight against me. So a catastrophic stop is intended to keep you in the trade, but within the next 4 minutes, If the market or the next four candles or the next four bars does not make your profit target, whether it be break even, whether it be a small loss, whether it be a small stop, whether it be a almost the winner or almost a catastrophic stop, this is a situation where you want to say there's proof that I should be out and I'm out of the trade. So time, catastrophic, a prove it stop, and a pivotal stop. Let's talk a little bit about what a pivotal stop is all about because I think they're important. When you look at a situation like this here, where the market goes like this and 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 like this. So these are what I would consider um, areas, pivotal areas where the market is cycling up and down. Now, if you took a trade, for example, right here to go long right here, this is your long entry right here, right there. Your pivotal stop would be just under where it pivoted. So I can see the market do this. I can see it start to go up. I'm going to use the most recent pivot plus 2 or 3 ticks as a pivotal stop. You can't have the pivotal stop exactly as this. So if I open this up here, because markets love to test where they've been. So this and this is all the same price. If you have the stop exactly at the pivot, it's likely that you may hit it to test it and you're stopped out. So give it a few ticks, 2 or 3 ticks, like this, for it to prove that it's wrong. Okay. And the same thing is, let me just quickly come over here. So let's say that there's a long trade right here as a scalp trade. This just under plus 2 ticks would be your pivotal stop. So I'm not using this exact value. Add a few ticks to it so it doesn't knock you out unnecessarily. All right. Anyone have any questions so far? All right, very good. The next thing we're going to look at is dynamically changing the type of chart that you're looking at and why we would do that. So when the market is slow, we have to look at a chart that this value that you're seeing here, the ATR here, is more in our area where we could stay into a trade. It could be 2 hours, 3 hours, 15 minutes, 10 minutes. When the market is faster, for example, personally, the 5-minute chart is what I like to trade. But if you look at a 5-minute chart, you can see that the ATR is at 12 points. So what does 12 points mean as a trader? 12 points means that each candle every 5 minutes is moving from high to low 12 points. Now, unless you're willing to have a stop that's a little bit larger or at 12 points so you don't get knocked out, this is a pretty big stop to have. And that's why you have to reduce the chart time so this is now more in line of the comfort zone. So we don't want to see 12 points because this is too much of a risk. Keep it about 5 or close to 5 or less than 5. And that's how and why we would reduce the type of chart from 5-minute to 3-minute to 1 minute. Or if the market is slow, you have to increase it to 15-minute. Mike says here, does this work in the Forex or commodities? So it works in the Forex and it works in the futures commodities. So if you're trading Forex, if you're trading futures, the E-mini, or even the micro ES, right? The micro E-mini, which is something that a lot of traders are now moving to because the risk is much less, much smaller. So if I change this to the micro E-mini, the results are very similar. 1 second here. Okay, so this is the micro E-mini right here. The results are similar, but the risk is less. You're not risking $50 per point if it goes against you. Okay, you got it, Mike. So use the micro E-mini as a way until the market slows down and the volatility is less. You have less risk involved. Let me change this also to the micro E-mini so we can compare the same thing. All right. So now we have the ATR. We have, let me just put this to a 1-minute chart. We have the trade scalper. We have the Atlas line. I mentioned earlier in the presentation that with a trade scalper, this is the signal. The next candle allows you to go in short.